Okay, I think we should start off now without much delays. Thank you once again for all of you to be, for making time and then attending on our webinars. Um, so we had internally, committed one webinar every quarter. However, this is our fifth webinar, and we are happy to, declare that we are going to increase our webinar velocity from here on. So we'll try to make it once in 2 months. So having said that, who are we? We are basically a team of experts. Um, we are into mainly advisory and consulting activities under the banner Anveshan Business Solutions, and we, refer ourselves as problem solvers or solution providers. So having said that, these are the different services that we provide under Anveshan banner and with past experiences. Thank you all for so of late we have been hearing about business succession planning. How does the businesses move across the generations, and then how it has uh, you know uh, transferred from one generation to other generation, or one person to other person. This is not a new activity as such, but it is something looked into in a structured manner of late. And there have been a lot of experts talking about this at various points in time across the globe. And we have been blessed to be involved in these kind of activities in the past. And thanks to our clients who have held trust in us, and then because of which we have gained some experiences, so which we felt we should share with our clients or our fraternity, and this is where we are. So today's agenda will quickly discuss about the need for business succession planning, and so we will briefly about why business succession and why planning. And next is overview of restructuring as means of succession planning. And of course, what is the importance of family settlement agreements in this aspect? And way forward, a brief about the different structures to explore. So the first subtopic being need for business succession planning. So as we understand, uh, we all know that as we understand, businessmen are the key drivers for these businesses and their success and their growth and their planning and their strategy. So, having said that, the businessman or woman does a lot of things during the course of the business and get to the stage where it would be at any given point in time, and the kind of risks that they take and the kind of thought process, the wild ideas they bring to the table, and also the risks that they undertake, whether within the locality, within the state, within the country, or overseas. The kind of thought process they bring is amazing. We are amazed with the kind of ideas or the risks that they take. While all this is being done, is is for what reason? Mainly to establish and grow the business. That being the case, that is where the businessmen um, are experts in, I can call them. So that being the case, while they are doing all these and then creating wealth for their themselves and the key stakeholders of the business, they should also look at how this businesses continue across generations post their lifetime also. Having this in mind, we felt these are four aspects that they need to envision or have in place, have in their thought process. That is, How does the business should move on post their lifetime or post their retirement also? Why lifetime? They may say that it's enough for them to take care of the business and hand over to the next generation. That being the case, who is that next generation? How do they, build the abilities of the next generation? What are the roles and responsibility that they need to have, and at what point in time they need to hand it over to? These are some of the critical questions that has to be answered while they are in the business. So that's where we call it as clarity of vision is essential. Primary, utmost primary, I can say. The next thing is the transition or the succession has to be seamless, because given the dynamics of the regulations, the dynamics of the situations that happen in business day in, day out, the business cannot lose out even a day of operations, cannot lose out any kind of activities, that is operational activities that gets carried out, and hence the transition or the business succession has to be seamless. That means to say there should be certain thought process prior to these such successions. That being the case, what are the thought process that goes into it? As I mentioned, clarity has to come in, and then what steps that needs to be taken at the time or the event of business succession. That is something which needs to be deliberated and decided, and it is always tailor made. It cannot be a copy paste formula for every situation. Next, any succession planning that has to happen, there should be a minimalist regulatory compliances. Of course, there are long shots, lengthy way of doing the succession and the easy way of doing the succession. And again, as I said, every formula cannot fit into the cannot fit into every size of the situation or the nature of the entity or the activity. It has to be understood, and then the businessman has to decide what suits them in the given circumstance. Of course, the last but not the least, it should have very less impact on the cash flows, as well as including the tax leakages. While we say taxes, it can be direct taxes and indirect taxes. So, having this in mind, the key aspects of business succession, let us also look at what are common issues faced in business restructuring. General, I mean, of course, there are a lot more issues that we come across, but we try to, categorize into these six buckets or six major activities or, sorry, issues. So one is family shareholdings across entities. So there may be multiple entities held by the families or the head of the family, and then the shareholding may be different in each of these entities. That is one situation which results in complications or issues basically from business restructuring or business succession perspective. The next thing is fragmented businesses across entities. So for different reasons, the entities are created. For whatever reason, at that point in time, the businessman decides to create different entities, but it gets fragmented, and the business may be similar business or auxiliary business or incidental business to the main business. Having said that, there are multiple entities created, and hence the succession planning also becomes even more complicated. And then comes your cross holding between entities. Generally, this is because of movement of surplus funds from one entity to another entity. Of course, there may be other reasons also. That being the case, there are cross holdings that results in intertwined, interest, business interest between the entities. And then when the succession planning has to happen, this is one amongst the common issues that we have come across, which needs to be resolved, without which the succession planning cannot be complete. The next thing is family assets mingled with the business assets. This for different reasons when decide to acquire assets, business assets, from the surpluses available in the entities, and it gets parked within the business entities. The next thing is intercompany dues accumulated over a period of time. So fund movement again, another reason of intercompany dues or intercompany balances. And the last but not the least is cash surplus that gets trapped within the entities, or I can say the reserves gets trapped into in within the business entities, which the businessmen generally prefer not to withdraw for one, to overcome or optimize the tax issues. That's the reason it gets left within the business entities. So these are some of the common issues that, of course, there are a few more which we can keep on listing, but these are common issues that we have come across in a group structure or a group of companies managed by. Having said this, okay, what is the next way forward? How do we achieve the expectation or the desire? And then how do we overcome all these issues? So way forward is what broadly that we would want to enumerate here. So the first and foremost, the businessman has to understand the family structure, who are the legal heirs within the family and outside immediate family. I can say who are the legal heirs within immediate family and extended family, because there may be certain times key stakeholders who participate in the growth of the business who are not within immediate family but part of extended family. So that being the case, the businessman has to understand the family structure and the legal heirs or the key successors for the business. Next is identify business assets and surplus assets. What do I mean by surplus assets here is the assets which are not deployed for the purpose of business activities. They, we address them as surplus assets. So identify those things. Then identify family members who can drive the business and have a clarity amongst them about their roles and responsibilities for each of their businesses assigned to them. So that is the next thing. And then map the businesses with family members. Once we identify the key family members who are responsible for running these businesses, map those businesses with family members. It can be through ownership, it can be through control, or it can be through both. And once we do that, establish a mechanism for ownership transfer and streamline the entity and holding structure accordingly. What do we mean by this? Once we identify the first four aspects, we need to identify what structure we should deploy to provide the control and the ownership to such member in the family so that they start managing those businesses. And this can be staggered, this can be at a point in time, or ownership can move later but the control can come in immediately, vice versa. So there can be multiple permutations that we can think of. Again, it is situation based or need based. Having said this, let's pick up quickly an example for why this business succession also is so. Why are we making so much hangama about business succession, right? So if you look at the structure, we have this is just an example, one of the examples. If you look at, there is promoters who are husband and wife, and then we have one company, company A, and then we have partnership, and then company B. Under company A, we have two units. One is business A and business B, and then operating properties held as well as surplus properties. Again, in undertaking B, we have operating property and then some surplus properties. It may be investments or it can be cash, it can be mutual funds, it can be immovable properties, anything of that sort. Then we have partnership A and B, and then, sorry, a partnership where we have one business plus surplus assets. Again, company B, we have surplus asset along with the business. Now, having said this, during the course of the lifetime or the management by the promoters, this is easy to manage because no one is there to be, reported by the promoters. They report to themselves and happy to manage this complicated structures or any of that sort. However, let's look at what So this is before going to the current structure, I mean, sorry, the desired structure or the optimal structure. We thought we'll run you through certain steps that needs to be achieved for having efficient structure. One is transfer of assets, ownership of the entity holding. This has to happen, and the removal of cross-holdings in company dues to fund or shell companies and immediate layers, because layers will not solve any problem, but it will add to the problem, and releasing of surplus assets from the businesses. And so this is the exact summary of what we discussed underway forward. So going back to this structure, looking at this structure in the view of the businessman, when he would want to achieve the succession planning, he would want the structure to be like this, where the promoters have two children, and business A has to be held by child one and business B has to be held by child two. The when I mean child one and child two holds these businesses, it can be ownership, it can be control, or both. So having said this, then if you notice here, all the surplus assets are moved to the family, and only the business and the operating assets remain in company one and company two, which are eventually managed by child one and child two. So this is the structure that any promoter would want to achieve um, at a situation where business succession has to happen. So having said this, so this I believe it has set a floor where we all understand the importance of business succession and the importance of planning for such succession. Having said this, I'll hand it over to my colleague Maithili, where she'll discuss about different means of restructuring. Over to you, Maithili. Maithili, you're on mute.
Thank you. Good evening, all. So thank you so much, Arun, for the brief overview as to why business succession planning is essential. We have seen so many structures where there are, as Arun mentioned, where we had multiple cases of property which is business related and also surplus assets which are sitting in. Now, a plain vanilla model for this would be a case. Once again, Arun, I'm not able to take control. Why? Can you just move forward in the slide?
You go ahead, Maithili. I'll manage the slides.
All right, perfect. So I think meanwhile we have one poll which has been put on the chat window. We just would like to understand what is it that everybody is looking forward to from as a stakeholder or as an advisor. Where is it that you're looking to address the issues of business succession planning? So I'll just give a minute for the poll to happen and all right, I'll just go ahead. Um, Meanwhile, when it's happening, okay, couple of there are different mechanics in order to achieve the desired structure, where we had touched upon that child one has to take over certain business, child two had to take over another business, and the family assets and all the surplus assets are parked out separately so that it is enjoyed by the family as a whole. And there is an equal partition or the partition as required by the promoter, what they envisage. Now, Wish life is very simple, and we have a one stage approach and one stage solution for all this. But effectively, what happens is that There is never generally a single solution to it. It is generally through a combination of mechanism is what it is achieved, either in the form of a plain asset transfer, or it can be in the form of a um, or it can be in the form of a slump sale, or it can be mergers or demergers. All these are just different mechanisms that have been done in order to in order to realize the final benefit, which is the succession planning in general. 1 second, just hold on. Sorry.
Maithili, is the slides moving?
No, slides are not visible, Arun. Would that be okay if I
Okay.
pick it up from my end?
Yes, yes, please. I'll stop sharing. Sorry, friends, about that.
Sorry, just 1 minute.
You're able to present?
Yes, 1 second, just hold on. Yeah, the screen is visible.
Yes.
Yes, okay. Sorry for this small delay. Okay, so I was talking about the different means of restructuring. The different manner that are there could be, it could be a plain asset transfer where the required asset also alone comes out. It can be in the form of a slump sale, or it can be transfer of shares. It could be a merger or demerger, or it could be any buyback of shares, or it could be a manner where if there is a HUF which is involved in the transaction, then it could be even a partition of HUF. We wish life was simple and we had one single answer for one-way street, which would answer the entire requirement of restructuring. But in most of the life scenarios that we have seen as part of our assignments, we have seen generally a concept where it is a combination of all these aspects, barring a one or two. It will usually be a permutation combination of different aspects which we use in order to achieve the required structure. Having said that, I will start from very plain vanilla fashion that we can use, which is in the form of an asset transfer. An asset transfer is it would arise in a very simple case where only one surplus asset or one particular property or one particular right, which can be an intellectual property right, is required to be transferred from one business or taken out of the business into another entity. Now, this is a very straightforward method and it is very simple to execute. The only kind of a documentation that it would require is a transfer documentation whereby one person or entity sells the asset and the other person is actually a purchaser of the asset. Now, if generally this kind of asset transfer is predominantly used in the case of either the usual circumstances are when you want to pull out a single asset or if there is an immovable property. Now there are certain um, there are certain constraints that and challenges that are encountered as part of asset transfer. One is if it is in the nature of an intangible asset, the concept of what is the value that needs to be assigned to that particular individual asset is something that would come up. And essentially, we need to have a certain value to this intangible asset. Now, you would ask that if there is a third party requirement, yes, of course, there would be a requirement of an valuation, and they would go about and see what is the untapped value of that intangible asset, and they would go in for a fair market valuation. But in a business restructuring, it depends on the life cycle of the intangible where you need to determine the value. Now, there are also, hence, because of that, the FMV of the asset needs to be considered. Having said that, if you need to go ahead with an asset transfer with a certain value, because it is a single value that's being transferred out from one entity to the other, there will be a GST implication to that particular transaction. And having said that, one indirect taxes applies, so also direct taxes applies, where you might have an impact of taxation on such kind of transfers. And when there is a receiving party and another party who's actually selling, there will also be a settlement of consideration, because the transaction would require a movement of consideration from one party to the other. Um, these are some of the common transaction costs that would be involved. Apart from that, if it is in the nature of an immobile property we are transferring, along with the transfer of title deeds, there will also be a stamp duty that would be applicable to the transaction in order to affect it. Now, if this is a very straightforward method, we can call it the plain vanilla method, where you're just taking one asset out. Though it's easy to execute, the challenges that are associated with this, that you will have tax outflows, as well as any consideration outflows or manner of settlement of the transaction needs to be necessarily undertaken. So these are the inherent changes. So considering that, if it is a single asset, okay. So what happens if it is in the nature of a business? We can't be transferring one by one each asset. That would seem humanly impossible to do. Now, if we have to look at another option for that, is where we would come to a situation which is called as a business transfer. Now, very commonly, this is called as a BTA, like when you want to refer it to as an acronym, or in legal terms, if you had to give a bigger word to it, we call it a slum sale as part of the income tax. Now, what is the concept of a business transfer? Business transfer enables carving out, first identifying if the entity has a business undertaking. Now, if there is a company which has, in the earlier case where we had mentioned, where there is a company A which has business A and business B as part of it. Now, business A and business B can be categorized as a separate division altogether, and where they can be identified with an individual assets, where you can have identifiable revenue, expenses, and where you can carve it out as a division, then it would fulfill the condition of a business undertaking. Now, a business undertaking, when it is actually transfer out, what happens is you're carving a portion of the balance sheet out and taking it out into another entity, which will be the receiving entity. When this is happening, the as per regulation, there is a requirement that you cannot be cherry picking assets and liabilities, saying that this is part of division, this is not. Once you have identified a division as a whole, then after that you can't do cherry picking of, along with this division, I'm adding one more asset which would I like to move. It will not fulfill the condition of what a business transfer is. Necessarily, it needs to be the entire segment which you identify with its assets and liabilities and the reserves that it has accumulated gets transferred out to another entity for a consideration. Now, what is the supporting document that goes with a business transfer? What we commonly refer to as a business transfer agreement. A business transfer agreement enables the movement of the entire rights to the assets and liabilities in the business, the carry forward of contract, along with the employees and all the rights that is on the underlying assets in that particular business. It moves like an entire sack full of data that would be there. It moves out to another entity. Now, one of the other things about a business transfer, just like the previous in asset sale, just that a single asset is not moving, but an entire division is moving. You need to settle this particular transaction through a consideration. The consideration typically can be either through monetary terms, where it is a full buyout with a staggered payment or a one-time payment, or it can be in the manner of shares of the other entity. Now, while undertaking this particular business transfer, one of the main criteria is that you need to demonstrate that there is a business undertaking. Now, in terms of people used to undertake valuation at book value, because that is what the law had initially stated. But because of the complexity of the assets that generally forms part of the division, say for example, if there is a property, like we had mentioned in the case of business A or business B, if there is also a property that is part of its operating asset, then you can't take the book value of the asset. The income tax mandates that even though you might ascertain the consideration saying that it's a transfer within the family and it can happen at book value, if there is a if there needs to be a fair value of the property based on, say, the stamp value, you need to necessarily take that value, replace it for in the place of book value, and then ascertain the consideration. This is one of the plugins that has been introduced by the government a year or so back with regard to business transfers. Otherwise, generally the norm with regard to business transfer was that you transfer the division, whatever is the book value, you can make the transfer at that particular book value. These pricing guidelines has been something that has evolved in the last 1 year or so as part of the Finance Act amendment. Now, the good thing about this kind of a business transfer is that the exposure in with regard to direct tax is only to the extent of the excess value that you pay over the net worth of that particular division, and it would be subject either to short-term or long-term capital gain depending on how long the division has run. But in terms of GST, because it is a sale of a business per se, it is considered as a ongoing concern nature. We won't have exposure to GST. So these are the norms with regard to business transfer. Now, moving forward, the one of the requirements with both asset transfer as well as business transfer is the fact that there has to be a consideration payout, which is either in the form of cash or shares or deferred payment. So there's always an obligation will come and sit for settlement between the parties. Now, we move to other processes which are possible and which can be looked in order to achieve the required structure. Now, as we have heard, this is something which is very commonly used in business language, which is called as mergers and amalgamations. Now, what is a merger or amalgamation is when two different entities can be combined as one single entity if they happen to be working on a same business. Now, in the previous example that we had mentioned, I will just take you back there. Now you have business A, which is there in company A, and business B. Now there is also a possibility where you can combine two business A, business B in company A and company B. This is just a possible structure. I'm just giving it as a basis without evaluating the pros and cons of it. If the division B of company A has to move out, this kind of a merger is also a possible. So when you fuse two different businesses is what it would refer to as a merger process. Now, this is very, very efficient methodology where you want to take off cross holdings or where you want to merge two different businesses into one single businesses. You've been just running an ancillary unit, which could be easily rolled into a main unit. This kind of activity could be undertaking. One of the best aspects of the mergers is that it will be tax neutral, and the consideration will generally be in the form of a swap of shares that can be settled. The main challenge with respect to mergers is that it is through a NCLT or a RD process whereby you need to go through the approval route and present documents and get the approval of all the shareholders, creditors in order to achieve the required structure through a merger process. And if there are any properties involved, then because there is a transfer, there would be also a stamp duty that will be possibly possible exposure that may have. Now, with the recent amendment in the Stamp Act also, there has been a revision with regard to restructuring and amalgamations and mergers, where they have said that it will be roughly around 5% of the value is what they had recommended, the Karnataka government had recommended. So this is one of the alternatives that can happen. Now, an alternative to merger is also another aspect that can be looked in for succession planning, and mechanism for achieving it is through demerger. As if you can recall in the first slide that we had, where a company A had division A and division B. Now, if B had to come out separately, with leaving out A, you can achieve the process through a demerger. Now, demerger requires one entity to transfer its division, and there should be another entity which should be receiving that particular division, which is called as the resulting entity. Now, this consideration for demerger also can be done through swap of shares, or can, if there are any minority play, you can also do through a settlement in cash. But one of the requirements is that the shareholders from here will also have to be shareholders of the demerged undertaking, or sorry, the resulting undertaking. Now, a couple of challenges with regard to demergers is that you need to have the concept of an undertaking under demerger. Then you will have to go through the required RD or an NCLT process. And if there is any property also, there would be a stamp cost that would be involved in this particular transaction. But demerger per se would also be tax exempt, provided all the shareholders continue to be shareholders and subject to the conditions that's provided under the Income Tax Act. So it's necessary that we need to see if that fulfills the condition of an undertaking, then demerger can be very easily executed. Only thing, it can be time consuming considering it, it goes through the NCLT. So there'll be a lot of procedural paperwork and approvals that needs to be sought. And if all the stakeholders in the form of ROC, income tax authorities, everybody gives a go ahead, then it is a simple process and it can help us achieve the structure that we want. Some of the other methodologies that we also have seen and used as part of aligning shareholding is also the buyback of shares. Buyback necessarily comes into a stage where if you want to remove a portion of the surplus cash that is available in the company, or if you want to buy back a couple of shares which are who are people who are non-family members from the share cap table. So a lot of companies use this mechanism. There are certain conditions that has been provided as part of buyback, which needs to be fulfilled to undertaking a buyback. You have a restriction with regard to a percentage capital beyond which you cannot undertake a buyback, and for a particular class. And you have to source the buyback. You can't source the buyback out of the same class of shares, and there are multiple other requirements that's been provided. But the good thing to note is that if there are any minority shareholding in the books, buyback can be used as a effective mechanism for buying out the shares of the outside party in the books. And any tax outflow in terms of buyback will be borne by the company. It will be an effective rate of roughly around 20%. And it also provides a mean for giving exit to other members who are not who are not part of the family, and because you're doing a succession planning, you don't want them to be part of the overall structure. So it gives a mechanism for settlement of their stake. One second. Another alternative is we have seen as part of the entire restructuring process for family houses that we also have a concept of HUF, which has been initiated as part of the old law where people had different, they held property in their individual name as well as the family name, which was a Hindu undivided family. Now, in terms of HUF, in the last few years of part of various HUF that's been seen, we have seen some active dissolution that has been taking place as part of HUF, and where the properties have been, where the HUF executed a total partition, and it has divided the entire assets in the HUF to the different stakeholders. Now, that division, I know under Income Tax Act, you have the leeway where it is not taxed. And this is also an effective mechanism, because going forward, how effective a HUF structure would be is something that needs to be seen, because any active investment or any investment going forward, people prefer to move out to a LLP or a company form of organization rather than HUF. This is more for where people used to have a sole proprietorship or a partnership, or the earlier form of organizations where it was very, very restricted And beyond family, there were no other participants. Those were the situations where people actually opted for HUF. Now, slowly, we are seeing the aspect where people are going to more organized form of organization rather than HUFs, or new consumption of HUFs don't happen from business perspective. But having said that, we wanted to touch upon that fact because we have seen some companies have businesses which also operate through HUF, and that also needs to be considered in order to get the what do you call, partition all the assets among the children, because the father HUF would still be active, the children, son and all, would be married. Now, what is the way forward for the father HUF? The only way forward for the father HUF is to partition so that it can be settled among the sons. Now, over to you, Arun. He will take it forward with regard to family arrangement.
Thanks, Maithili. My suggestion is you can continue the controlling the slides.
Okay. All right.
Okay. And meantime, friends, there is one small poll. Request you to participate in the poll, which will be launched now. Yes. Request all of you to participate. And also another announcement, since we are recording this session, we will be hosting it on our YouTube channel also. You are free to access it as and when you deem fit. And also we will share this presentation with all the attendees. And also any questions on any of these topics, request you to put across in the chat or the Q&A tab that we have in the Teams meeting, and we will be addressing all these queries towards the end of the session. Okay. So getting back to the session, friends, we understood from Maithili that she spoke about various restructuring options that we have. And one or the other option that she spoke would be certainly used or adopted in family run business successions or any other business reorganizations also. That being the case, we will the best way to do is check whether which model or which structure is best suited for achieving the desired restructured situation. And then also timelines is important. As Maithili mentioned, mergers or demergers going through NCLT route is quite prolonged activity, but nevertheless, it has its own advantages. Um, Apart from that, we can always stitch together one or two combinations of these structures, or one or more structures or the options available, and then achieve the desired it becomes all the more important. While when we have lot of options, it is important to analyze each of these options and then adopt it or use it for implementation. Having said that, one critical or one more important aspect that any of us have to have in mind is, especially in case of family run businesses or family assets locked in business entities, family arrangement, that is an arrangement amongst the family members, becomes all the more important. Why? This is an arrangement or a document that is signed off by amongst the members, which will provide clarity amongst all the members as to what is that the way, the manner in which the assets. Maithili, can you move to the next slide? Yeah. So this slide exactly explains what is the significance of family arrangement, or we can also call it as referred to as family settlement. It captures the family intent, focus being peace and harmony amongst the family members. Of course, it is all the more important. No one of us will want fights within the family or outside the family, also extended family also. That being the case, with the intent of having peace and harmony, call out all the intentions of the business owner and the expectations of the family members, identify who are the parties to the arrangement, It can be within the family or extended family also. And next, it can be different generations. It can be two or three or four generations being party to it. And it will also capture what exactly each of the members would get to control and get to own. It can be in terms of surplus assets, or business entities. Number four, it also helps captures the valuations that have been adopted for the purpose of splitting, the assets or the businesses across asset classes. And next, it can also call out who will. There may be multiple family members who would want to jointly operate such or one or many businesses. Then those final cap tables also can be called out. What do I mean by funnel cap table? The ownership structure. It can be the one of the businesses or many businesses can be assigned to one member or multiple members, where they together jointly operate and grow the business. And also it have the structures or the means in which succession planning has to be achieved. So, and next, timelines. Timelines are very important. There can be staggered timelines as per the intent of the family head, or it can be an immediate implementation activity, or certain aspects can be implemented, for implementation immediately, and certain aspects can be staggered. It can be a permutation combination of these things. So this is where in just the family arrangement talks about or would generally capture. Of course, we can always it can always bring in the other aspects to it also. Maithili, next slide. Yeah, ways to settle family members. So, identifying the assets and resolving any conflict mechanisms that may arise or that is already arised amongst the members. Um, and then the split, how the split happens amongst the family, and the have clarity on who is holding what at present, and then post restructuring, how it would be done, and then the process to be adopted that also needs to be identified, and the timelines to be done. Apart from this, there may be incidental documents that needs to be, or the arrangement that needs to be captured along with family arrangements. That is, it can be an escrow arrangement. For example, one example, simple one, I can say, till one member gets cash payout from one of the entities, the shares of that entity can be held back by the family head, or it can be parked in escrow, and then post transfer of money that member two gets. Till then, the shares can be parked in escrow, and post money transfer, member three will get the shares. So this is a simple example of escrow arrangement where the event will happen upon satisfying a condition or achieving a goal. Then there can be deferred payment arrangements. The reason why deferred payment arrangements comes up is, again, one simple example. It is not possible for anybody to pull out all the surpluses that are there in the business entity at one go. And hence, there has to be a deferred payment situation so that the business doesn't, get feel the pinch, and the business doesn't suffer because of shortage of funds. The other aspect is in the gap. When I say in the gap, in the time gap, or between the start date and end date of implementation, there can be stopgap arrangements where the members would expect, and those arrangements also can be documented as side agreements or in the main family arrangement agreement itself. So this is another mechanism or to document all the thought process, all the decisions that have been taken within the family in relation to the business succession. Yeah. So from here on, the next slide, Maithili. So,
You
apart from this, yeah, there is another alternate that we generally recommend for few situations, or we have come across where the private trust structure also has been adopted, which is a private trust itself. It is a trust in the form of a trust, but for the purpose of managing the affairs and the assets of the family, it will also include the business assets. So it can be revocable or irrevocable. It can be determined or indeterminate. We are not dwelling into it in detail here because we have a separate session on this, which we have done. However, to have a brief about it, we are capturing it here because it can also be adopted as part of business succession planning. So what it can do, it can hold multiple classes of assets, including businesses. It can have pooling of assets, and then we can actually call out who is having how much of interest in the trust assets, and what point in time they become beneficiaries, and what point in time the secondary and tertiary members become beneficiaries into the trust, how it has to be managed, when it has to be liquidated, who will get the rights to manage it. All these things can be called out. In fact, one important thing that we have seen is the ownership and the control can be segregated or separated amongst the family members through a family's private structure, sorry, family trust or a private trust effectively. So that is the benefit of having a private trust in place. But of course, there should be a need that arises, and post that alone, private trust has to be looked into. Otherwise, it doesn't become effective at all if just for the sake of having it if you have it. Then other benefits of private trust is, it can be executed for the benefits of family members. It can protect the businessmen against liabilities. That is, the business liabilities cannot touch the private assets or family assets. Apart from that, there are certain taxation implications. If it is indeterminate, then maximum marginal rate of tax applies. So we need to be, cognizant of that, and then be careful on structuring the trust appropriately. So this is about the private trust. Now I would hand over to my another colleague Vijay Simha, who will briefly talk about what are the other entities, other types of entities that we can look into while we are implementing or planning for business succession. Over to you, Vijay Sinha.
Thank you, sir. Hi, this is Vijay Simha. I'll be taking forward with way forward. That is the kinds of entities we can explore if we have to achieve the above structuring mechanisms. And before I go forward, we just have a small poll. I will be posting the same. Just take a moment to respond. Okay. So I'll be going forward. Ma'am, can you please? Okay, thank you. So the first one is sole proprietorship, like which we are all aware of and we will be seeing in most of the cases. To take an example in the given context, let's say there is a business that is taken over by the family and it goes to one particular child. It goes for him to manage alone. Let's say he has to manage it as a sole proprietor. So that is when sole proprietorship can come in. But again, when we have to see sole proprietorship, we have to look into the challenges one has to face. So let's say after the demise of single owner, the continuity of the business will be a challenge. And the growth of the business, let's say when we have to look at fundraise or any other things, For a sole proprietor, it is more challenging than an LLP or a company. And then partnership, again, within the family, if let's say a husband and a wife are getting into a partnership and they continue the same, again, even here, first and foremost challenge is that the liability will be unlimited. So if the business goes for a loss, it can come up to the personal liabilities of the partners. And the second one will be the succession of the business. In case the husband and wife are the partners who have a single child, so this time the succeeding this partnership will be a challenge. And in case of two partners, on demise of one partner, the partnership also might come to a cease. So that way, sole proprietorship and partnership would be easy to execute, but it has its own challenges. Next. So, and then if we have to see which is better, now we first went into sole proprietorship and then partnership, and then something better than partnership is LLP. So these are the edges an LLP has over partnership. Like it has the benefit of limited liability of capital, which we are all aware of, and that is only limited to the capital contribution. And we can safeguard the assets within the LLP because this liability is limited. Also, in LLP, it is easy to raise funds, and there are many other regulatory regulatory benefits available. Let's say in case of fundraise or any such thing. So LLP would be preferred over a normal partnership. Then going on, the best alternative here, like most of the times when we suggest or advise anyone, will be company. The first one is again the limited liability for a company wherein the personal assets of the family or the promoters are ring fenced within the entity. So the risk of losing out is not there. And then as we all see today, the fundraising is being made more easy for companies. The promoters can go forward and raise funds through various avenues, let's say angel investors, venture capitalists, and all of them would be more confident in investing in a company rather than a sole proprietor or a partner. And then the tax rates, again, there are many other new tax regimes, let's say 115 sections, BAC, BAB, and all that. So again, the tax rate would be lesser than what it goes for an individual. In case of individual, it might be 30% at the slab rates, and under Section 115, it will be 15%. And then to retain talent, again, a business cannot be run just by the family members. It will need professionals who have been part of the business for a very long time. To retain them, there are, again, we might give them sweat equity, ESOPs, and many other avenues. So again, these things will not be available in LLP. So company has an edge over all of it because of these reasons. So when looking at the above restructuring, let's say I have to merge, demerge, anything, we have to look at, okay, what kind of an entity am I going to finally end up with? And this will again change most of the decisions and the process that has to be taken care during the restructuring mechanism. So yeah, going forward, I think this brings us to the end of the important part of the presentation. Now I will request Maithili ma'am to take over and talk about what we can offer you in this regard.
Just to add there, along with the concept, people prefer company with regard to fundraising where they have any other form of investors coming in. LLP is still a very suitable avenue because it has the benefit of limited liability. At the same time, if it is going to stay within the family itself, LLP might be a better option. Only in terms of withdrawal of profits, it gives you an edge over the company. As compared to company, it's easier. But if it is the future of the business is need to be on a growth trajectory, then you need to seek other avenues for funding. Then company is certainly, and also we have the benefit of better tax rates under a company where even have for a manufacturing we have a 15% tax rate, so that would completely work in the company's favor. Now, with regard to our offerings, thanks to all the clients who have helped us actually hone this particular knowledge, We've been able to do a lot of business family arrangements. We have managed to restructure and provide solution for a lot of our clients. And a key aspect happens to be always been that we customize the solution and space make it specific to the requirement of the particular assignment and what is the requirement of the stakeholders, and we have helped them achieve the solutions. And it has always been a consultative approach, and we have always tweaked the requirements based on the and customized it based on each of the scenarios and what is the possible solution and what is best for the family, and to take it forward as a whole, and also considering what is the growth potential for the business and how they wanted to raise funds and everything. So we have worked on that space. And from our previous webinars, you also would know that we have worked on the funding side and provided any enablement for startups and long-term compensation plans and other aspects as well. So I can never bracket as a particular service offering. We are more a solution provider within the regulations, within working within the regulations, and our main focus has always been addressing the pangs of the business houses and what is required for a growth step forward. So that has been always our way we have approached each assignment and how we have offered solutions as well. So I open the floor to Q&A. Anybody has any query, we'll take it here. I believe there are a couple of questions on the what do you call, on the chat box. Vijay, would you be able to pick it?
Yeah, I see only one first
I can
question
see
by
two.
Shankar Shastri.
Okay.
Two, is it?
This anonymous says here,
Go ahead.
with your experience, what is the most preferred way of succession planning, given that more than one options are available for a given case, and why?
So I will take it up.
Yes.
Arun, if it's okay.
Yeah, go ahead.
Well, so as we started the webinar, that was one thing that we had put it out saying that I wish we always had a situation there had been one size fits all. So everybody can wear it and go ahead and execute. But in a past experience, it has always been a combination of different items, and it has never been um, a single form of a solution that we had. It's always been a blend of different solution because each case has been used to address a specific requirement. There are some cases in which where the focus has been with regard to carrying forward the business with no captable hassles and things like that, and it was a clean division. If it is a very clean split of business where one company has two business, even a BTA will work faster. But always there has always been the issue of what if there is a property element to it, or where if it is there is some more amount of what do you call excess cash to be taken out or some other form of settlement. So we have always used different mechanics in order to achieve. It also depends on the complexity of the structure, how complicated the particular structure is. We'll have to look at that particular aspect and see. In terms of implementation, BTS has always been easier and simpler and faster to execute. But having said that, mergers and demergers, where there have been complex structure cases where we need to solve a particular structure, or where we want to carve out the business, keeping in mind the future of the particular intent of the business house, mergers and demergers also has worked very well for some of our clients.
There is one more question. They've asked that how do we do the valuation for assets and liabilities during a slump sale? Is it required to be given by a valuer?
Okay, so where does the concept of valuation for assets comes up is predominantly from scrutiny proceedings, whether income tax or a GST official picks it up. Now, from GST perspective, there is no issue because it's a sale of a business as a whole on a going concern basis. From income tax, the requirement is that it provides the mechanism in which the consideration has to be computed. It doesn't provide that it needs to be certified. The certification aspect generally happens only from net worth perspective, where we need to get a net worth certificate for the particular what do you call, transfer of that particular undertaking. Otherwise, it can even be self-computed. But as a general practice and a general hygiene that we generally recommend is that it's okay if you can have a chartered accountant sign off, or particular professional sign off, in order to substantiate the deemed consideration calculation.
Yeah, just to
Arun,
add to what Maithili mentioned. See, if you look at from business succession perspective, let's say one of the means to do is, let's say, slum sale, and each of the business entities has different valuations. So at least for the settlement purpose, or understanding amongst the family members how the business entities have to be settled amongst the family members, a valuation may be required, because each value has its own valuation based on different valuation methodologies that we have, and we have been using of late. Our recommendation would be that family members have to understand what is the value that basis which the assets or the business entities gets split. To that extent, at least a valuation may be necessary.
okay. So Arun sir, can you take up the question that is in the chat by
Yes,
Shankar Shastri sir? And
yes, yes.
also, I have given mic access to every attendee here, so you can unmute yourself and ask any questions.
Okay. So, Mr. Shankar Shastri's query is, if paternal aged parents transfer all their assets to one of their kids to manage all their assets, mainly with an intention to take care of their medical expenses and maintenance till their death demise, and post which the complete assets to be used only for medical requirements of any other family members. Please suggest mode of trust and also tax implication for the same. See, so it's a trust would be a better structure in this situation. Why? Because the settler of the assets can clearly call out what is the main intention of the trust that is being created, and the purpose of for which the assets are being transferred to the trust. However, certain things needs to be taken care here, as to say to or to mention that who are the beneficiaries of this trust. Having said that, once you have the beneficiaries, it is also all the more important that the relationship between the settler or the person who is transferring the assets to the trust and the beneficiary, if it is fitting within the definition of relative under Section 56 of Income Tax Act, as long as it is within the definition, there is no tax implication. Else, we will have to understand what implication that may come up. In the sense, it may lead to tax issues. Having
Okay,
said
but
that,
yeah.
yes, yes, go ahead,
So
Shastri.
just at the time of transfer of assets, I believe there won't be any tax in the hands of the trust, correct?
But it also depends on who is the beneficiary.
Correct. Now, as of now, they say that it is only for their own benefit they are transferring, because they are
Then
aged, so nobody else is
no
there to take
tax.
care of them.
Yeah, no tax at first level. But
Okay.
let's say post lifetime of primary beneficiaries, if you are
Okay.
calling out all the members of the family or extended family as beneficiaries, then there would be tax implications.
So only on the spending, depending on the spending, it gets taxed in case if it is spent on a non-relative person, correct?
Yes,
So,
you're right.
okay. So, and can the medical expenses be covered as a charitable purpose, or is it something which will be still be a gift?
That's altogether a different aspect, yes, but I will try to briefly address. The moment you bring charitable angle to it, it becomes a public charitable trust, and you're
Okay,
exposed
okay.
to public scrutiny,
Mm.
and you cannot restrict it to the family alone or extended family alone.
Uh,
It has to be open for all the members of public. So
so
even
there
I
is
should be
no
benefited
concept
out
of
of that
private
trust.
charitable.
No, there is
There is no
no
concept
concept
of
of
private
private
charitable.
charitable. It can be charitable or private.
Okay, got it. Thank you.
Thank you. So members, we have another 18 minutes. So let's make best utilization of that. If you have any questions, please call out. In the parallel, I would request my colleague to launch feedback poll and request every attendee to please provide your feedback, positive or any recommendation for us to improve, or any other topics that you intend to listen to, which we can certainly bring it up.
So there is one more question here in the Q&A. Is private trust structure adopted by families mostly? If this alternate option is available in that case.
Yes, private trust is mainly meant for families. And what we have seen of late is every person who holds certain amount of wealth is looking at creating family trust for himself or herself, because it has certain benefits. Like, for example, we can ring fence the assets from business exposure, business liabilities. We can document well the succession of these assets, that is transfer of ownership. It can be personal assets, it can be business assets, it can be liquid assets, it can be immobile properties. All those assets can be captured and pulled into the private trust. It is a much better option, alternate, compared to a will. Will comes into effect only at post lifetime of the member. However, family trust becomes effective immediately. The next question I see, do I take it that the slab sale is on basis of book value? So as Maithili mentioned earlier, there is a specific rule, that is Rule 11 UAE, which talks about the computation mechanism to arrive at the valuation of the business undertaking. However, it only provides a basis to arrive at minimum value. It doesn't say that that is the only value that you have to consider for the purpose of transaction. It can be any value above that. And for any value above the book value, there are different methodologies to be adopted. Okay, so Mr. Murthy is asking what are the advantages and disadvantages of private trust? Sir, we have a separate session that we had done. I'll see if I can share the recording with you. But in brief, I can say that only if there is a need for private trust, then alone we should look at. And the advantages, as I mentioned shortly, sometime back, you can actually call out the methodologies of transfer of transmission of assets from one generation to the other generation. You can specifically call out who are the beneficiaries and who are, and exclude all others. You can in fact exclude the any other member whom you do not wish to also, though they are part of your family, you can exclude them absolutely. However, we should also be cautious about Hindu succession law, because any asset that comes within the ambit of Hindu succession law, that we need to be careful while structuring the private trust, because we cannot exclude certain members if even if we wish to, if the succession act or succession law is applicable. However, we will certainly share the presentation or the recording with you on the private trust, which is a detailed document.
Okay, so now we will be launching the last poll about how your experience was in this webinar. Please do take a moment to rate that. Also, you guys can refer our YouTube channel for our last webinars about estate planning, startups, or ESOPs. So thank you. Thank you for your time.
Also, we'll be happy to have your feedback. Please provide your feedback in the chat so that we will certainly consider it for our subsequent webinars.